What have you got, Steve?
I've got another company of about the same size. It's another proper tech stock, by which I mean it's down by about 47% since the start of the year. This is Guidewire software. It's more of a CRM than anything else, but it's quite a specialist sort of CRM. It's a CRM aiming specifically at the insurance sector. So it's got things like a claim center and a billing center and a place where you can kind of manage policies and that sort of thing. And they've recently added on a data business, which is pretty much the biggest anywhere on property casualty, stats and data and so on and so forth, which is kind of helpful for insurers who need to use data to make decisions and so on and so forth. We won't talk about that too much. This has a market cap of about 5.2 billion when I looked earlier today. I think the stock is down today, so it's probably lower. Now that it's Sunday, it's probably got a market cap of about 1.5 billion, which will ruin everything I have to say about valuation in a little bit. But broadly speaking, here's some stuff about the business. The insurance industry hasn't changed very much since the 1950s, actually, in most cases, and that's a feature of insurers tending to be, by nature, quite risk-averse. So when they see some new techie thing, they tend to not commit to it particularly soon. They were very slow to get out of their panic on Y2K and all the kind of mania around that. But that means that their systems advance at a much, much, much slower rate. And that's fine for most of the time. But if you're still using 1950s systems, you're starting to reach a kind of problem point where there aren't any developers that use and are fluent in 1950s programming anymore. Younger developers don't know what they're kind of doing with those things, and you need something that they can kind of use and speak to and help you with. So there's a whole bunch of insurers then that are looking to kind of upgrade their systems, and there's a big battle for them, and Guidewire is winning it. They currently cover about 25% of the direct written premiums, so ordinary property casualty stuff, and they're winning it by some way. They win more deals in a year than all of their competitors combined, from what I see of it. It means, though, being 25%, there's plenty more of that market that's not accounted for yet in theirs. If they're the biggest player with 25% and there's not a huge number of others, there's still a long way to go in terms of getting more stuff. And getting more stuff is what they're up to at the moment. So what you want to do in this kind of sector, we've talked about CRMs before, but just to remind people, is basically you want a big installed base of your product somewhere, and then you can kind of make your money by selling renewals and high margin add-ons and things like that. So what they're effectively trying to do is get people onto their system for the time being, and they're doing a reasonable job of it. Their sales have doubled, so they've compounded their growth from 13 to 26 to 52 for the last 3 years. They're probably not quite going to double it again this year, but they are adding new clients at quite a rate. We know these businesses tend to be sort of fairly sticky as well. Once people are in that system, they don't tend to get out. And indeed, Guidewire has been operating for 20 years now, I've got written down, and it's never lost a customer to a competitor, which I think is kind of a fun stat. That's the broad overview of the business. That doesn't tell you quite why I'm buying it yet, but any thoughts on it so far?
Who are its competitors?
Their biggest competitor is a bunch called Duck Creek, who, when I looked, they have fairly similar kind of approval ratings to Guidewire, but they're a distant sort of second. They're the bunch who might do something in terms of grabbing a meaningful share of the kind of remaining market, and a lot of the market is there to be grabbed by kind of cloud and software, modern software based systems. But they're the one to keep an eye on. Then I'm not sure whether they're publicly traded or not. I think they might be. But they're a fairly distant second, and they're also a specialist bunch here. So there isn't a kind of Salesforce insurance or something like that, if that's kind of what you are interested in. There is a kind of Salesforce non-profit which bothers other CRMs, but yeah.
Yeah, I'm just looking at their their various financial sheets now, and they've got quite a pile of goodwill in there. So I guess they've been quite acquiring heavy. I'm looking at selling expenses and R&D expenses. They're up a lot as well. They've almost 4x to their R&D expenses in the last 10 years, and the same really with their selling, general and administration expenses. So are they experiencing some tough competition at the moment, or is this something that they just need to do to keep in front?
There's a couple of things that are bringing that about. To the goodwill point you mentioned, they've recently acquired something called Hazard Hub, which is a massive property. That's their data thing, basically. It's the nearest lazy comparison related to this show that I can think of is LSEG acquiring Refinitiv or something like that. So they now have a great big data thing that, that got spent quite a lot on. They can't really do it by raising debt because they're not profitable yet, and you don't want to take on huge amounts of debt if you aren't generating the cash to cover it. The reason that kind of expenses associated with sales have been going up is they're busy pivoting people off of license systems and into cloud systems, which they are thinking should pay off longer term, but that is driving up cost of sales at the moment. And you're kind of right here, Steve. Their financials make them a tricky proposition to value, and I'm reluctant to get into anything that I can't kind of value very well. So I've had a bit of a bash, but it takes a bit of doing here because it's loss making and it's free cash negative. And worse yet, as you point out, some acquisitions there are kind of making their accounts look funny. And harder to sort of predict. But here's the things that we know about them. They're about 812 million in revenue, and they have a market cap of 5.2 billion. So 6.5 times sales if you're interested, which I'm not. Based on where interest rates I think are likely to be and so on, I'd be targeting a 6% return because I think that'll be higher than a 30-year bond, and I think it'll be higher than inflation in the long term. I know obviously we're losing to inflation at the moment with that, but I'm expecting it to settle below 6%. So what does that mean? I'm looking for 11.5 billion in free cash over the next sort of 2 decades, which gives me 2 questions. Number one is, what is the free cash flow margin going to be when we get to actually producing free cash? We're not there yet. When we start kind of adding on the higher margin stuff, and what's the growth rate going to be? And just looking at kind of other CRMs and tech companies and software in particular, companies, eventual kind of free cash margin of around 30% seems kind of about where I think this is going to settle, which means, what are we going to take with a 30% margin? What kind of growth do we need to produce enough free cash to justify an investment at 5.2 billion today? And the question then comes, well, when are we going to get to free cash positive? And if it's next year, then revenue would be fine at 1.3 billion, which is a 23.5% growth rate over a year, which strikes me as unlikely for Guidewire. But if we're a bit more patient and we're prepared to wait out to year 5, we need 1.3 billion in revenues. That's a growth rate in revenues of 9.87, which seems to me quite likely, actually, they could do that. And if we're prepared to wait it out till year 10, it's an 8% growth rate. We need, on a 30% margin, 1.74 billion, which from where they are is 8% in growth rate. That also seems kind of achievable to me. So they're forecasting 10% this year for what it's worth. So it's on track for their hitting their mark in year 5 if they start to turn free cash positive there. And with a kind of decent runway ahead, I reckon they probably can do this. It feels all quite tight at the moment, doesn't it, in terms of not finding much of a margin of safety stuff. But if you think about these kind of starts turning free cash positive in year 5, I don't think it's going to turn free cash positive in year 5. I think it's going to produce enough money to justify that in year 5. It's been free cash positive for a few years now and coughed up 87 million sort of here and there and so on. So the cash coming off that in the first place kind of gets you your margin of safety here, I think. And if you've got a longish time horizon, I also think, by the way, it won't just stop after 10 years and then not grow at all. I think these kind of things will continue to move up past once they've reached their kind of growth number that I'm looking for on these things. But I think this could well get there with these sorts of things. It's a stock that's highly out of favour at the moment. No one likes expensive looking tech companies. No one likes unprofitable tech companies especially. But when people don't like these sorts of things, I like to go looking for them. And Guidewire kind of catches my eye in the way that a lot of them do.
I mean, you can see it on these stats. They've got a pile of cash. They're not actually losing as heavily as you would expect. And I'm just looking through the free cash flow here. In 2017, it was as high as 130 million as well. So that that's quite impressive conversion metrics. You can see the point where they must have pivoted away from selling an annual product to selling something in the cloud, because you can see those margins have started to decrease. You would assume as that because they're running 2 products side by side, one of which, the money is realised over a longer period. So you can see those margins they've dropped from being around 65% to around 43.5%. But, you would expect those margins to start, at least for gross profit, to start increasing again. And if they can get that 43 back up to 65, then this company should generate quite a decent whack of free cash flow, which makes your figures sound quite quite plausible. The only guess reservation I've got with it does have a little bit of debt. I assume that's from the big acquisition. But yeah, it looks interesting, Steve. It looks interesting to me.
It does have a bit of debt in there. Its debt's covered by its cash, and you're dead right to point out that you don't want too much debt knocking around in a company that's not generating profit here. I mean, the correct thing to do in this situation, if you really need to finance something and you can do it, would probably be to do it through stock, for what it's worth, because you have to pay back debt, and if you're not free cash positive, what the hell are you going to make an interest payment with? But yeah, when I looked at its debt, I think it was lower than its cash on hand, its total debt, so that made me worry a bit less.
Just having a look at it now, cash on hand 254 versus 300, but if you add stock to that, it's about 1.1 billion in cash and equivalents. So it is quite considerably covered, but it's covered a lot. So I'm just looking at this through my phone. You basically got the same amount of goodwill as you do in debt, which is I'm trying to find holes here. I can't find too many, to be honest with you. You've made a really good case. I'm just trying to look through the cash flow and everything myself. The only thing really that sticks out like immediately is that increasing net loss that keeps coming every single year. We're in a trend for net loss, even though our revenue is going up in it. And I'm just having a look at some of the acquisitions. Is this revenue going up by acquisition? They made a big acquisition. They've made pretty big acquisitions for the past 2 years, haven't they? And that's what's been going on there. So yeah, and what did they sell? They sold something in 2019. They sold something big. That might be something looking at as well. They spun something off by lots of things. Yeah, interesting. Very, very interesting. I'd like to know more about exactly what it does. Because this is well out of the competency range for me at the minute, but I'd love to know a lot more about what it does, just to really get my head around it.
Yeah, just looking at this, you can actually see the correlation between the gross profit starting to slip. I mean, if you pull this up, guys, on ROIC.ai and you type in Guidewire, you can actually see the drop in the gross profit. As that starts to slip, the net income obviously starts to turn negative. So this is a company that, 2016 was net margins of 3.5-4%, whilst still growing at a fairly decent clip. But then they've obviously started this transition to cloud, and you can see the effect that this had to their accounts. And if you actually have a look and compare this to Adobe when they started to do their transition as well, you'll see the same thing. And Adobe went through a period of time where people really disliked that stock because they didn't believe the switch to a monthly subscription was the right idea to do, because the monthly subscription was cheaper than the annual subscription. But the idea being that people would sit on that for a lot longer and would not stop paying. And that's what's paid out for Adobe and gives them a lot of predictability in the revenue and things like that. So this is the transition that Guidewire are on, but we are, rather than Adobe, which has matured and now on the opposite side of that, you're looking at something that is currently going through the transition of, tuning down the gross profit, trying to sell a monthly or a more regular subscription product, and the net income is suffering temporarily because of that.
It'll be a while till their metrics start looking like kind of classic easy valuation stuff. I mean, it will start to look a bit like, my thought is Salesforce, and then it will start to look a bit like Adobe, and then it will start to look a bit like, I don't know, maybe Intel eventually. And if you're looking for a dividend, it's going to be a very, very long wait, I think. I'd be surprised if they ever pay one. I think they would probably more likely do it through buybacks if they wanted to return capital, but I think even that's a way off yet for these guys. They're still very much in kind of aggressive growth mode. They see a market they want to get hold of, and they're going for it. Yeah.
No, this is a standard undercover kind of software stock. It's not a big old, flashy, got to grab investors kind of software stuff. This is under the radar, and they're going to need a little bit of incentive to push through to get some more investors in. I think that's what. I mean, not now. Obviously, we're a long way for it. But this isn't a Google where they're going to sit on cash for thousands of years.
I think this looks to me like one of those software companies that somebody like Vista Equity Partners just kind of just kind of soaks up and becomes, part of their private equity company, because it's just kind of got a kind of steady business. It's got a large share of it.
Yeah.
It's got a recurring subscription to it. It looks just like a Vista Equity Partners kind of business.
Yeah. This is a $20 billion Adobe buy. This is, isn't it? This is because of the drop. Like so far, this is the sort of company that's going to get acquired for stupid amounts of money compared to what it's actually valued at right now.
Was this the company, Steve, that you said you guessed was going to get acquired at some point?
No, I wouldn't mind guessing that this was going to get acquired at some point. It's about the same size. It's slightly bigger, actually, than the company that I guessed was going to get acquired at some point, but it's doing slightly better. The company I guessed was going to get acquired was Blackboard, which is the social good or non-profit or fundraising CRM. That, like all my other predictions for this year, is currently going very, very badly. But we'll see.
Far, far below January 19 and January 20 prices here. You go, historically you're doing really well. This looks really, really cool for anybody who's interested in like that future prospective growth. There's a lot going on here, isn't there? Scary as well.